Hi, my name is Bob Kendall. You know me from the Kendall Report. I help you manage your portfolios and protect your wealth. The way that I do that is through our software platform, Portfolio Expert. This platform is amazing. It covers over 16,400 symbols. You can build as many portfolios as you want to manage and to protect your wealth. What you'll find by setting up a trial of our software is that we're going to train and walk you through every step to become what we refer to as an ETF hacker. We're going to show you how to take your favorite ETF and make it something really special, and it's owned by you. We also call this building your own personal funds. And what that means is you're going to build your own personal mutual fund. It is all yours. You can pick the stocks that you do, and the software will walk you from A to Z, telling you when to buy and sell, how much to buy and sell, including helping you to protect your capital through the signals that when the market rolls over will get you to cash and out of harm's way. It's very simple from here. It's just sign up, click the link down below. We'll get you in our system. As soon as you get in there, we will notify you of a live webinar to walk you through every step so you understand exactly how to use this product and how to manage your portfolios and protect your wealth. Sign up now, just click the link below. Welcome to the Kendall Report, where I share my 41 years of experience to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. As we look back on yesterday's action, the S&P was up 0.7, NASDAQ up 1.2, and the Russell down 0.9. And that spread that I had talked about going back to last July is actually starting to fail. And I think this is important to talk about tonight. As I mentioned in last week's live stream, and I also mentioned it previous week, and that we are likely to see the techs start to claw back their leadership. And we're seeing that happen over the last several sessions. Yesterday, Apple and Tesla and many others were definitely very strong markets, and it felt really good. But I have to tell you, as good as it felt, the momentum's not increasing or indicating that we're likely to make a breakout just yet. The markets still have a fair amount of work to do in this area before we're going to be able to move out of this zone. I think we're going to continue to stay in this very choppy range. As we look at the futures, they did trade down to that 38 handle, down to 38.86. That is most likely the bottom of this pattern, and we're just going to chop in a sideways range. And I'll go through all the details here in a few minutes in the technicals. As we look back on yesterday, we saw the existing home sales come out down 6.6%. Now that sounds really bad, but the reason they were down was there's no inventory to be sold. So this is important to understand. The real estate market remains very tight. This will continue to keep the housing inflation expanding. It's not going to end just yet. The key number we're going to see on Tuesday is going to be new home sales. Now, if those are greater than 880, that will actually show that it's relieving some of the inventory issues. But as the housing market goes forward, it's going to continue to be tight. You know, we've seen lumber quadruple in price. We're starting to see a lot of things across the economy that are actually up in price substantially. Even common commodities like corn and wheat, soybeans, a lot of those commodities have skyrocketed. But as we come into Tuesday, it looks like we're going to have maybe a more flat session, not a follow-through session. There's some key numbers that I'll talk about here in a minute, but we're just not seeing a lot of elements that I was hoping that we would see after the actions. As I mentioned a minute ago, it appears that we're just going to continue to grind in this zone. While our database continues to be stable, it's still in a long ways from signaling that the market's ready to go as well. So we have the breadth of the market from the WaveTech viewpoint. We're also not seeing the momentum come into play. A quick mention about market sentiment. I think it was interesting that last week when the 10-year went over the 1.64% that it was bearish, we traded up to 1.75, and now we backed up to 1.68. And that's somehow bullish. It's still greater than 1.64, but the logic behind the market sentiment never makes sense. It's basically a day-to-day. So that was the factor the other day. Today the factor was that it was down. So it appears that interest rates just aren't going to keep expanding. The trends on the interest rates are still very firm. I discussed this in yesterday's video. I'm going to continue to track this. I'll go through a lot of details on Wednesday's live stream. Let's go ahead and take a look at the charts, see how they're set up for Tuesday. As I review the WaveTech database, there were 736 new buy signals, 972 sell signals. We downticked just slightly on the percent bullish down to 25.89. We continue to hover right around that 22% level. In the opening comments, I mentioned that we're not seeing the breadth in the markets on a short-term database, and this is exactly what I'm talking about. We need to get over 0.42 to actually get a sustainable database, but we're definitely going to have to see this thing increase well above where it's currently at. It still remains somewhat vulnerable to a sell-off, because if we do close below 22%, that would suggest a full liquidation of database, which typically will take us down to 14 to 8%. At the moment, I'm not expecting that, but there is some risk in these markets here for them to roll over. I know that we just printed all-time new highs last week, but the short-term breadth is very weak. And as I mentioned in last night's video, the weekly database continues to hang in there. We're still around 75% bullish there, and we did not see a lot of selling coming in. So I suspect this consolidation or a sideways pattern is most likely what's going to unfold. As I review the S&P 500 futures, they're up 0.75 on the session, but you'll notice when we look at, as we look at PPM1, you'll see that it is actually crossing back through its first derivative. PPM2 is actually showing some promise, but the support levels are down where we printed late last week and down into that 38.85 level. That is where the primary support levels are. As we look at the market grid for today, we're looking at the possibilities of a R1 39.44. It looks like a 38.82 is likely in this pattern, which would be an S3 number, but for sure we're looking at an S1, S2 on the downside. I believe we'll have a slight bias to the downside. The pivot number will be yesterday's high, however, which was at the 34.44 on the futures. Let's take a look at the SPX. And the SPX, it did see the PPMs increase at 0.30, but they will downtick also if we come in just flat to slightly down like the futures are trading at the moment. So we're definitely going to see some backfilling here on from the viewpoint of the PPMs. And that just suggests that we're still got more work to do in this trading range. Take a look at the expectations for today. R1 39.50. Yesterday's high 39.55, so possibility of retesting the highs at 39.55, S1 39.29, S2 39.16. There's a little bit more of a discount since we just rolled over to the June futures, but there's definitely some potential downside. Not a lot. I don't see us trading below those moving averages in this pattern, which are around the 38.90 level. So any retracement likely will hold, and I just don't, as I said, I don't expect to see this market roll over here. As I review the NASDAQ futures, we did see it trade up very near that 40-day moving average. I discussed that yesterday. I thought we would run back up toward that level. That's 13,194. Yesterday's high was 13,157, so we came just short of that. Pulled off of those highs just slightly. Overnight, we're seeing some weakness, down 27 handles right now, back to 13,046. As I look at the market grid for today, you see the high overnight's 13,105, R1 13,157, S1 12,986. So we haven't quite printed there, but I think we could. It's possible we're going to see an S1, S2 low for today, and I think there'll be a lot of resistance at this R1 level at 13,157, which is basically where yesterday's high is. Now we do see the PPM1 rolling over. We're no longer in trend mode. we're still positive, but not in trend line. And PPM 2 has crossed over its first derivative, but PPM3 remains negative. As I mentioned in yesterday's commentary, is that I do expect to see this thing remain in the sideways range, sandwiched between the 21-day and the 40-day moving average. That's 12,913, 13,183. That is also confirmed by the market grid for today. Next market I'll cover is the Russell. The Russell was down 0.91 back to 2266. If we look at the configuration of the moving averages, the 21-period moving average is 2222, and PPM2 is actually flat. So this suggests that we could get through this level, trade down to the 40-day moving average, which is 2161. As we look at the market grid for today, you'll see that the S2 is 2162, so it's possible we're going to see an R1 S2 as we come into Tuesday's session. I want to take a quick look at the spread, the Russell versus the NASDAQ, and you'll see it's starting to roll over pretty good, and I've been very concerned about this just because this trade is just so mainstream. In the last couple of weeks, if you turned on CNBC or went to Market Watch, Yahoo Finance, you name your site, that's all they were talking about, is that the Russell and the small caps and the mid caps were going to be outperforming the large cap techs. That trade just got way too mainstream, and it looks like there's going to be some backfilling here. I don't think it's a really long-term trend, but also on Wednesday's live stream, I'll go through a lot of detail on this stuff at that time. But for now, I would be very cautious as you go forward. If you have any small cap stocks, watch them very closely from the standpoint if they're breaking any of their key levels. The final market that I will cover tonight is gold. Gold's been very quiet over the last several days. We're just remaining above the 21-period moving average. That is at the 1732 level. Last trade 1733, the low 1732.60, so spot on that number. The high 1739. As we look at the market grid, R1 1744, and that 32 number is S1. It looks to me that the 10-period moving average is vulnerable at this stage at 1729. If we get through that level, then expect to see 1725, 1718 on the downside. Could go as low as STX number in this pattern. We're still got a lot of work to do here, but this does appear that we're setting up a classical right shoulder on this pattern. As I mentioned in last night's video, just covered again briefly, is that the weekly 10-period moving average is down at 0.56, which will be substantial resistance. It's at 1774, so we're not going to get above that level for sure this week. If we look at the market grid for the weekly, the R2 is 1771, R1 1755, so we've almost got to an R1, S1 1727, so we basically have had an S1, almost R1, and I suspect we're going to remain narrow. There is some vulnerability to the downside to at least the 1712 level, and the extreme would be that 1696 level in this pattern. It would take a break over 71 to make any type of major move, and that's not going to happen with this kind of configuration. This will complete the video for tonight. Thanks for watching. We'll talk to you tomorrow night. Hey folks, if you enjoyed this content, make sure you subscribe, hit that like button and the notification bell so you'll know when I do these videos.